Good day everyone, I'm Chanchal Agarwal from Eastern Financiers, and today we are going to discuss the thematic investment play on India IT sector. The discussion is divided into three parts. What happened into this sector in the past 2 years post-pandemic, how is it spanning out currently, and what the future holds for us. So in the past 2 years post-pandemic, we saw many employees from the established IT firms leave their job to either start on their own or join tech startups into the areas like blockchain, cryptocurrency, Web3, given by the whole ethos that has accelerated in the post-pandemic boom, lucrative salaries that these tech startup firms offered, ESOPs and striking equity valuations, etc. There's this data by Randstad India which says that for every single IT personnel, there are 2.5 offers at a given point of time, which says that there is a high supply demand gap in this sector, and rightly so. That is seen in the attrition rate, which is almost at 2-decade high of 21 odd percent, which means that 1/3 of the employees are quitting their jobs to join one of these startups. This can also be seen in the reported numbers by firms like Infosys, which has attrition rate of almost as high as 28 odd percent. Tech Mahindra attrition is at 24 odd percent. In fact, Tech Mahindra said that they lost 2% of the margins because of the high attrition post-pandemic. So that was past. Now, how is it spanning out currently? Unfortunately, given by the rising US interest yields and given the fears around recession, we have seen that the liquidity flow into these startups have stopped off, right? Which is affecting the next funding round that they are intending to raise. So, the private equity fund which used to fund these startups are seeing losses rising. So, for example, somebody like a Tiger Global, which is one of the highest successful equity hedge funds, have reported a loss to the tune of $17 billion this year. In fact, they have wiped off 2/3 of the cumulative gains that they made since inception of 2001. SoftBank, which is very well known portfolio investor, has lost almost 18.6 billion on their portfolio in just this quarter alone, right? Back home, we've seen what has happened to Paytm. They lost almost 65,000 crores. Zomato has lost 2/3 of the investor wealth since its peak. On the unlisted side, somebody like a Farmeezy has lost more than 50 to 60% of their traded value, right? So what happens when there is no funding, you're losing out on your market cap? The first thing to save costs is, of course, you lay off your employees, right? And this is a new trend which has started to pick up in US. So you've seen since November of 2021 till now, there is an accelerated startup layoff that's happening, and a similar trend of course has started to emerge in India. So the past 4 months, if the numbers are to be believed, almost 5,700 employees were laid off. Swiggy has started to downsize its grocery and daily essential arms, where it's almost shut in 5 of the 6 cities that they had started off. We of course all know what happened at BharatPay, Unacademy, and so on and so forth. So I mean, how to play this trend? Essentially, if the quit or layoffs have started, all these employees who had left their stable IT jobs will start moving back to places where they see stability, even if it could be at the option of reduced compensation packages or ditching their stock options and so on and so forth. So we believe that all these employees will come back to established large IT players, which could of course help these players gain the margins that they had lost in the past 2 odd years. One could build a staggered systematic exposure via MFs and ETFs. In our note, we have listed out a couple of MFs that you could look at from Tata, ABSL, SBI, and ICICI. There are also ETFs from ICICI and SBI that you can check out. Thanks.